All right, let's get started here. I know it's small print, but I got to get the questions on the screen somehow, and there's just a lot of typing. I don't think you need this much narration on each question, but there it is. This person over here has designed a sophisticated forecasting model which predicts the movements in the overall stock market in the hope of earning a return in excess of a fair return for the risks involved. Sounds like a speculator, right? Earning a return in excess of a fair return. He uses the predictions of the model to decide whether to buy, hold, or sell the shares of an index fund that aims to replicate the movements of the stock market. Takabe would best be characterized as hedger, investor, information-motivated trader. Well, that's not a hedger or investor. We call that an information-motivated trader. That is just a nice way to call them a speculator now. Speculator has such a dirty word since Obama won office. It's just such a dirty word that we now call them information-motivated traders. And what gives it away here is it wants to earn a return in excess of a fair return. James Beach is young and has substantial wealth. A significant proportion of his stock portfolio consists of emerging stocks that offer relatively high expected returns at the cost of relatively high risk. Beach believes that investment in emerging market stocks is appropriate for him, given his ability and willingness to take risk. Which of the following labels most appropriately describes Beach? Hedger, investor, or information trader? That's an investor. Lisa Smith. Complicated names here, eh? Owns a manufacturing company in the United States. Her company has sold goods to a customer in Brazil and will be paid in Brazilian real in 3 months. Smith is concerned about the possibility of the real depreciating more than expected against the US dollar. Therefore, she is planning to sell 3-month futures contracts on the real. The seller of such contracts generally gains when the real depreciates against the US. If Smith were to sell these future contracts, she would most appropriately be described as hedger, investor, or information-motivated trader. In this case, this person is a hedger. Which of the following is not a function of the financial system? To regulate arbitrage profits, to help the economy achieve allocational efficiency, to facilitate borrowing by businesses to fund current operations. It is A. That is not a function. The function of the financial system is not to generate a specific return, not to control the return, and not to dictate what a return should be. It's number 2, yes, achieve allocational efficiency, and number 3, facilitate borrowing by businesses and by government and by individuals. An investor primarily invests in stocks of publicly traded companies. The investor wants to increase the diversification of his portfolio. A friend has recommended investing in real estate properties. The purchase of real estate would best be characterized as a transaction in the derivative instrument market, traditional investment market, or alternative investment market. Well, I hope you're with me on this. We can eliminate A. It's not a derivative. Is it a traditional investment or alternative? Traditional investments, remember, stocks, bonds, things like that. Real assets are considered alternative investments. And that might seem odd when you realize or when you think about this and you think, but real estate has been around for thousands of years. Financial assets are relatively a recent arrival on the scene. Wouldn't they be the alternative investment? You would think, right? But no. 6, a hedge fund holds its excess cash in 90-day commercial paper and negotiable certificates of deposit. The cash management policy of the hedge fund is best described as using capital market instruments, money market instruments, or intermediate term debt instruments. Well, we have 90-day commercial paper and we have negotiable CDs. Remember, those are less than a year, up to a year. So, a year or less, we'll talk about money market securities. An oil and gas exploration and production company announces that it is offering 30 million shares to the public at $45.50 each. This transaction is most likely a sale in the futures, primary, or secondary. Well, the company is offering the shares to the public. So it's not investor to investor, it's issuer to investor. So what do we have? Primary market. Consider a mutual fund that invests primarily in fixed income securities that have been determined to be appropriate given the fund's investment goal. Which of the following is least likely to be part of this fund? Fixed income securities. Okay, least likely, warrants, commercial paper, or repo agreements. Oh, I say repo, repurchase agreements. Well, commercial paper is a fixed income security. Repurchase agreement is a fixed income security, but a warrant is not. A warrant is considered equity. So, A is least likely. Now, I should say this. It says here, invest primarily in fixed income securities that have been determined to be appropriate given the fund's investment goal. We're not told what that investment goal is. We're just told the fixed income securities are appropriate. It is not uncommon to be able to buy bonds with warrants attached. And if that is the case, you are quite likely to find warrants in a fixed income fund. But the question says least likely, so we have to go with that, although I would make the argument that it would not be uncommon to find warrants in a bond fund. A friend has asked you to explain the differences between open-end and closed-end funds. Which of the following will you most likely include in your explanation? And I didn't cover this in the review, so I'll cover it here. Open-end and closed-end funds are pooled investments. Think of them as mutual funds. An open-end fund means that if you want to buy units or sell units, you do it directly with the fund itself. If you buy units, you buy at the net asset value. If you redeem your units, it's at net asset value. A closed-end fund, on the other hand, issues shares in the open market, and there's a certain number of shares, which is why it's called closed-end instead of open-end. And those are the only shares out there. If you want shares, you got to buy them from someone. When you sell shares, you got to sell them to someone. And because you're not buying and selling with the fund itself, those shares may trade below, at, or above their net asset value. So let's answer the question now. Which would we most likely include? Closed-end funds are unavailable to new investors? That's kind of tricky. You might think, well, yeah, because there's only a certain number of shares. Well, no. I may say I want in on this closed-end fund. I simply just have to buy them in the open market from someone, so they're not closed to new investors. They're not issuing new shares, but they're not closed to new investors, so we can eliminate that. When investors sell the shares of an open-end fund, they can receive a discount or premium to the fund's net asset value. When investors sell shares of an open-end fund, they're selling it directly to the fund at net asset value, so they cannot receive a discount or premium. They get NAV. I must choose C. I've eliminated the other two as just patently false. When selling shares, investors in an open-end fund sell the shares back to the fund, whereas investors in a closed-end fund sell the shares to others in the secondary market. Yes. The S&P, Standard & Poor's Depository Receipts, the SPDRs, SPDRs, those are just called SPDRs, is an investment that tracks the S&P 500 stock market index. Purchases and sales of SPDRs during an average trading day are best described as primary market transactions in a pooled investment, secondary market transactions in a pooled investment, or secondary market transactions in an actively managed investment. Well, these are traded on an exchange. So trading during the day, this is not a primary market, it's secondary right away. We can get rid of A. So is this a pooled investment or an actively managed investment? This is just an index. It's an investment. It just tracks the S&P 500 stock market index. It's not actively managed. It basically passively tracks the 500. So we can get rid of active management. Secondary market transaction in a pooled investment. Which of the following statements about exchange-traded funds is most correct? So let's underline our keywords here. Exchange-traded funds are not backed by any assets. The investment companies that create exchange-traded funds are financial intermediaries. The transaction costs of trading shares of an exchange-traded fund are substantially greater than the combined costs of trading in the underlying assets of the fund. A, exchange-traded funds are not backed by any assets. That's not true. Quite a few ETFs are actually backed by physical assets, so we can eliminate that. C, transaction costs of trading ETFs, exchange-traded funds, are greater than the cost of the asset. If that were true, no one would do it. They have to have some benefit, so we can eliminate that. We must take this, which is true. The companies that create the ETFs are financial intermediaries. The usefulness of a forward contract is limited by some problems. Which of the following is most likely one of the problems with a forward contract? Once you have entered into a forward contract, it is difficult to exit from the contract. That is true. That's a drawback of a forward contract because you've customized it and you've entered into it with someone else. A futures contract, on the other hand, is very standardized, very easy to get in and out of. So that's true. But we're looking for most likely. Maybe there's something more likely, right? Entering into a forward contract requires the long party to deposit an initial amount with the short party. That's called a margin requirement. That is simply not true for a forward. It's also not true for a futures. The long party does not deposit a margin with the short party. In a futures, the long party deposits a margin with the clearinghouse, and the short side deposits a margin with the clearinghouse as well. C, if the price of the underlying asset moves adversely from the perspective of the long party, periodic payments must be made to the short party. No, not in a forward market. A forward market, there's only one-day settlement, which is why you have counterparty risk. In a futures market, there's marked-to-market settlement, which means daily settlement. So the most you could ever be out if the other side defaults or disappears is 1 day. Must choose A. Tony Harris is planning to start trading in commodities. He has heard about the use of futures contracts on commodities and is learning more about them. Which of the following is Harris least likely to find associated with a futures contract? Existence of counterparty risk, standardized contractual terms, or payment of initial margin to enter a contract. Well, futures are exchange-traded forwards. They're very standardized, so it says here which one are they least likely to find. You're going to find that they're standardized. You must reject that because we're looking for least likely. You do have initial margin entering every contract. So is this existence of counterparty risk? And that's true because the clearinghouse is the counterparty to every contract, not the other side. So there is no counterparty. It is the clearinghouse. A German company that exports machinery is expecting to receive $10 million in 3 months. Since I got a dollar sign there, it's a German company. I'm going to assume that's US dollars. The firm converts all its foreign currency receipts into euros. The CFO of the company wishes to lock in a minimum fixed rate for converting the 10 million to euro, but also wants to keep the flexibility to use the future spot rate if it is favorable. So they're looking for a right to do something, but not an obligation. Sounds like an option so far. What hedging transaction is most likely to achieve this objective? Selling dollars forward? Well, no. You sell a forward contract, both parties are obligated. That does not leave any flexibility. You're obligated, so that can't be right. Buying put options on the dollar. Well, that's an option. And since I'm buying the option, I'm long the option, I have the right but not the obligation. It sounds like what I'm looking for. Selling futures contracts on the dollar. Well, no, that's just the same thing as selling forward, selling futures, except one's exchange traded, one's OTC. You're still obligated. The only thing that allows me to have the right but not the obligation is an option. A book publisher requires substantial quantities of paper. The publisher and a paper producer have entered into an agreement for the publisher to buy and the producer to sell a given quantity of paper 4 months later at a price agreed upon today. This agreement is a futures contract, forward contract, commodity swap. Well, you have two people entering into an agreement one to buy, one to sell a specific asset at a specific price at some certain date in the future, and they're both obligated. That sounds like a forward or a future contract, so I can eliminate C, even though that sounds reasonable. What are they swapping? Paper for money. No. So it's either futures or forward. Does that sound like it was done on an exchange? No, I don't think so. That is a forward contract. Standard & Poor's Depository Receipts, the SPDRs, is an exchange-traded fund in the United States designed to track the S&P 500 stock market index. Sounds like the last question, right? The current price per share of SPDRs is $113. A trader has just bought call options on shares of SPDRs for a premium of $3. The call options expire in 5 months and have an exercise price of $120 per share. So these are out-of-the-money call options. On the expiration date, the trader will exercise the call options, ignoring any transaction costs, if and only if the shares of SPDRs are trading below 120, above 120, above 123. Well, anything above 120, I make money. Now, you may be arguing, but you paid $3 for it. Well, that's true. My break even is 123. But anything above 120, I start losing less money up to 123. So I would exercise that call option anything over 120. If I exercise at 121, I lose $2 instead of $3, right? If I exercise at 122, I lose $1 instead of $3. So anything over 120. 17. Jason Schmidt works for a hedge fund, and he specializes in finding profit opportunities that are the result of inefficiencies in the market for convertible bonds. Bonds that can be converted into a predetermined amount of a company's common stock. Schmidt tries to find convertibles that are priced inefficiently relative to the underlying stock. The trading strategy involves the simultaneous purchase of the convertible bond and the short sale of the underlying common stock. The above process could best be described as hedging, arbitrage, or securitization. Well, he's looking for, and it says here, finding profit out of the inefficiencies in the market. So he's looking for mispricing in the market. That is arbitrage. 18. Pierre-Louis Robert. You can't say Robert now, it's Pierre-Louis. You got to say Robert, right? Like Colbert, Stephen Colbert. Pierre-Louis Robert. Just purchased a call option on shares of the Michelin Group, or should I say Michelin, of the Michelin Group. How's that? A few days ago, he wrote a put option on Michelin shares. The call and put options have the same exercise price, expiration date, and number of shares underlying. Considering both positions, Robert's exposure to the risk of the stock of the Michelin Group is, well, let's have a look at what he did here. A few days ago, he wrote a put option. He purchased a call option, and he wrote a put option. So he's long a call, he's short a put. So what are we hoping here? When you're long a call, you're hoping the price goes up. When you're short a put, you're hoping the price does not go down. So in other words, you're hoping the price stays the same or goes up. So both these positions are in the same direction. He's on the same side of the market on both of them. So is he long, short, or neutral? He is long on this one. 19. An online brokerage firm has set the minimum margin requirement at 55%. What is the maximum leverage ratio associated with a position financed by this minimum margin requirement? Well, we know the maximum leverage ratio is equal to 1 over the minimum margin requirement. So that is 1 over, what's our minimum margin requirement? 0.55. 1 divided by 0.55 will give us 1.8181, on and on. I think 1.8181, 1.82. 1.82. Let me just do that while I'm here. 1 divided by 0.55. 1.818181. I thought it was repeating. There we go. 20. A trader has purchased 200 shares of a non-dividend paying firm on margin. So we have a non-dividend paying firm. We got 200 shares on margin, price of $50. Leverage ratio is 2.5. 6 months later, the trader sells these shares at $60 per share. Ignoring the interest paid on the borrowed amount and the transaction costs, what was the return to the trader during the 6-month period? Okay, well, we have our leverage ratio of leverage ratio 2.5. Look up here. Maximum leverage ratio equals 1 over minimum margin requirement, right? So we could just put 1 divided by 2.5 and see what we get. And that will give us 0.4. So that means our minimum margin requirement must have been 40%. If the shares were purchased at $50 at that leverage ratio, that means the margin is what we put up. We put up 40% to $50. So 50 times 0.4 equals, we put up $20. It says here 6 months later we sell them at $60, ignoring the interest paid on the borrowed amount. And the transaction cost, what was the return during this period of time? Well, we paid 50, we sold it for 60, which means we've made $10 on this, right? So we've made 10, and it cost us 20. 50%. Do we have 50%? We got 50%. 21. Jason Williams purchased 500 shares of a company at $32 per share. 500 shares, 32 per share. The stock was bought on 75% margin. What is margin? Margin is me, which means I put up 75%, or Jason put up 75. 1 month later, Williams had to pay interest on the amount borrowed at a rate of 2% per month, 24% a year. That's wicked. At that time, Williams received a dividend of 50 cents per share. Immediately after that, he sold the shares at 28 per share. Paid commissions of 10 on the purchase, 10 on the sale, 20 round trip. What was the return on this investment for the 1 month period? So we need two things. We need return and we need investment, because we have to figure out ROI, which is our return divided by our investment. So what was our investment? Well, it was $32 a share times 500. But we only had to pay 75% of that cost. So if you multiply 500 by 32 by 0.75, you'll get $12,000. But we had to pay $10 on the way in. We can't borrow that. We got to pay that. So we put up $12,010. Well, what did we get on the outside? $28 a share at 500. So we sold it for $14,000. But we got to pay back the loan. The initial cost was $16,000. We put up 12, which means we borrowed 4. We got to pay back that 4,000. So there's $10,000 left. But we have costs. It cost us $10 to get out of the stock. We have 2% on the loan for 1 month. The loan was $4,000. 2% of $4,000 is $80. Got to pay that $80. But we did receive dividends of 50 cents a share, 500 shares. We received $250. So our return, our total return in the end was 10,000. Well, what we got out was 10,160. We can't say that that is our return yet. What is our return? It is we put up 12,010. So our return is 12,010 minus, sorry, I'm doing that wrong. Let me just reverse that. We ended up with 10,160 minus what we originally put in, 12,010, divided by 12,010. So I need the return on the top, my investment on the bottom. That'll give me negative 1850 in my numerator over 12,010 in my denominator, which will give me a return of negative 15.4%. Do I have that? 15.4. Caroline Rogers believes the price of Gamma Corp stock will go down in the near future. She has decided to sell short 200 shares of Gamma at the current market price of $47. The initial margin requirement is 40%. Which of the following is an appropriate statement regarding the margin requirement that Rogers is subject to on this short sale? Need to contribute $37.60, need to contribute $56.40. She will only need to leave the proceeds from the short sale as deposit and does not need to contribute any additional funds. Okay, well, it's 40%. You have 200 shares. You're going to sell them at $47. That's a 4 and that's a 7. And on top of that, we're being told that we must post a 40% margin. So multiply this by 0.4 and we will get 3760. 3760. Is that an answer? She will need to contribute $37.60. So 22 is A. The current price of a stock is $25 per share. You have bought you have $10,000 to invest. You borrow an additional $10,000 from your broker and invest $20,000 in the stock. If the maintenance margin is 30%, at what price will a margin call first occur? So a margin call, remember, is equal to our price multiplied by 1 minus the margin divided by 1 minus the maintenance margin. So what's the price of the stock? It's $25 times, what is the margin? Well, you had 10, you borrowed 10, so it's 0.5. And it says here, if the maintenance margin is 30%, 1 minus 0.3. Will give us 25 times 0.5 divided by 0.7, and that'll give us 1786. 1786. If you're wondering why I switched from green writing to yellow writing, it's because I filmed this in front of a live studio audience and the feedback was negative on the green. A market has the following limit orders standing on its books for a particular stock. The bid and ask sizes are the number of shares in hundreds. So here's our book, here's our bid, here's our ask. The bid is what's available for sale. The ask is what's available for purchase. I'm not used to seeing it this way. I'm used to seeing it the other way where the asks are up here and the bids are down here, but we could just read it the same way. Typically the price would climb. So you'd have it here, the price is climbing as we go down instead of up. It is what it is. What is the market? Well, we say the market is where the best bid and the best ask is. So the best bid is $9.95. Let me see if I can write on this one. $9.95. There we go. And the best ask is $10.02. So the market is $9.95 bid to $10.02 ask. What do we have? $9.73 bid? Nope. $9.81 bid? Nope. $9.95 bid. So we could have just went down and said, well, the best bid is $9.95. Offered at $10.02. There's where the market is at. Consider the following limit order book for a stock. The bid and ask size there are a number of hundreds of shares. So here we go. It's in yen. So the market is 123.35 bid to 123.80. A new buy limit order is placed for 300 shares at 123.40. Buying at 123.40. The limit order is said to, well, what's the best bid we have so far is 123.35. Somebody's coming along and saying, hey, I'm willing to pay 123.40. So it would show up in here, 123.40, and you'd have a 3 over here. The limit order is said to take the market, or make a new market. It is making a new market. Currently, the market in the stock is 54.62 bid, offered at 54.71. A new sell limit order is placed at 54.62. This limit order is said to. So if we're looking at our bid to our ask, we have 62 to 71. I'm just going to drop the 54 handle. A sell order comes in at 62, so it's going to sell. It's saying, I don't want to wait for the 71. I'll sell at 62. It's going to sell on the bid. The order is said to take the market, or make a new market. Making a new market is somewhere in the middle. Making the market is I'll sell at the same price somebody else wants to sell it. Taking the market is saying that's what somebody wants, I'll take it. Take the market. You have placed a sell market on open order, a market order that would automatically be submitted at the market's open tomorrow and would fill at the market price. Your instruction to sell the shares at the market open is, well, what are we specifying here? We're specifying when an order is to be executed. So if we're specifying when, that is a validity execution or validity instruction. It's valid when at that time. So on 24, we would go with, what do we have? Execution, validity, and clearing. We would go with validity. Jim White has sold short 100 shares of Superstores. Oh, that's Donald Trump's friend. White has sold short 100 shares of Superstores. They're so great. At a price of $42 per share. He also simultaneously placed a good till cancel, stop 50, limit 55 buy order. Assume that if the stop condition specified by White is satisfied, so the stop condition is satisfied, and the order becomes valid, it will get executed. So we're assuming that it gets executed. Excluding transaction costs, what is the maximum possible loss? So we are making the assumption that it's executed. Why is that important? I'll explain why in a second. What is the maximum loss? Well, we shorted at 42. We have a stop out at 50. I didn't explain this in the review. The stop loss, whenever you have a stop loss or a stop buy, it executes as a market order. Simple as that. So if I have a stop loss and the price gets hit, it will execute as a market order. Now that market order may actually push the price. So I may not get exactly what I want to be stopped out at. So typically with a stop, you'll also put a limit. So this limit is a pretty safe limit, saying, look, if it gets to $50, give me a market order. But just in case the market's really stupid and crazy, let's limit it to $55. Anything over 55 is clearly a temporary, and I'll get a pullback and I'll be okay. I don't want to get stopped out at the worst possible time. But it's saying here that you did get satisfied, that it did execute, you did get satisfied. So we don't have to worry about, well, maybe we have a standing limit order of 55 and the market moved way beyond that. If it did, what is the maximum loss? Could be unlimited. But in this case, it says we did get executed. The maximum loss we could have is it went all the way to the 55. So it had a stop at 50, but the fast-moving market brought us to the limit at 55. Our maximum loss would be $13, but we have 100 shares. That would be $1,300. And since we're friends with Donald Trump, we're not going to pay it. Simple as that. I don't like the deal. We're not paying. 29. You own shares of a company that are currently trading at $30 a share. Your technical analysis of the shares indicates a support level of $27.50. You are most likely wearing a shirt unbuttoned halfway down your chest. You probably have one of those little thin douchebag beards that just go down the side of your cheeks. and your hair's probably full of grease. All right, now that we got the setting, let's see what we have. That is, if the price of the shares is going down, it is more likely to stay above this level rather than fall below it. If the price does fall below this level, however, you believe that the price may continue to decline. So you think you have support at $27.50. You have no immediate intent to sell the shares, but are concerned about the possibility of a huge loss, if the share price declines below the support level. Which of the following types of orders could you place to most appropriately address your concern? Short sell order, good till canceled stop sell order, or good till canceled stop buy order? Well, you wouldn't short sell. You're long, and short selling is a box trade. It just means you're flat. You may as well just sell your current position. So it's a good till canceled. It's either a stop sell or a stop buy. Well, what do you want to do? You own the shares. If they're dropping, do you want to buy them or sell them? You want to sell them, right? So it's a stop sell. If you were short the shares, it would be a stop buy. B, good till canceled stop sell order. 30. In an underwritten offering, the risk that the entire issue may not be sold to the public at the stipulated offering price is borne by, what do we have? An underwritten offer is borne by the issuer, the investment bank, or buyers on the part of the issue that is sold. Well, a bought offering, this is a bought offering, an underwritten offering where the entire issue is bought by the investment bank for one price and then they sell it to the public for another and hope to make the spread. If they can't, they lose. The investment bank. 31. A British company listed on the alternative investment market of the London Stock Exchange announced the sale of 6,686,665 shares to a small group of qualified investors at 0.025 per share. Which of the following best describes this sale? Shelf registration, private placement, or initial public offering? Well, they're already listed. They're already listed, so it's not an initial public offering. It may be a follow-on offering, but it's not an initial public offering. They simply just announced the sale of the shares to a small group of qualified investors. So that wasn't offered to the public. It was offered to a group of qualified investors. That is a private placement. 32. A German publicly traded company, to raise new capital, gave its existing shareholders the opportunity to subscribe for new shares. The existing shareholders could purchase 2 new shares at a subscription price of $4.58 per share for every 15 shares held. This is an example of a rights offering, private placement, or initial public offering. Well, in this case, we didn't cover rights offering, but you could take a reverse strategy and say, well, I don't know the right answer. Let me identify the wrong ones. It's not an IPO. This is clearly not an IPO. It doesn't sound like a private placement because it's existing shareholders that could do it. It's being offered to the general public in a sense. The general public that are currently shareholders must be a rights offering. Here's what a rights offering is I will offer my existing shareholders the option to buy certain shares in proportion to the amount of shares they already hold. So let's say I want to float 10% more shares. I will give all of my shareholders the right to buy 1 share for every 10 shares they held at a particular price for maybe the next 2 weeks, the next 15 days, the next 30 days. That's it. They're very short term. Rights are very, very short term in nature. They're meant to get an answer very, very quickly and raise money fast. This is a rights offering. 33. Consider an order-driven system that allows hidden orders. The following 4 sell orders on a particular stock are currently in the system's limit order books. These are sell orders. Based on the commonly used order precedence hierarchy, which of these orders will have precedence over others? So which one will get executed first? So let's have a look. So there are sell orders. We have 2033, 2029. So it's the best sell order. 2029 is the best. So it cannot be number 1. Let me change the pen color here so we can see that. It cannot be number 1. So it's either 2, 3, or 4. They're all at the same price. This one is hidden, so it cannot be 2. It must be a displayed order. So we can get rid of those 2. So of these 2, it's whichever one arrived first. This arrived at 5304, 5349. 3 has precedence. Order 1, Order 2, Order 3. For 33, you must answer C, Order 3. 35. Don't worry, I know I went from 33 to 35. It's just a matter of what can fit on the screen. I'm going to put 34 with 36. So let's do 35. A market has the following limit order standing on its books for a particular stock. So here's our sells, here's our buy orders, here's our sell orders. Ian submits a day order to sell 1,000 shares, limit 1983. Assuming that no more buy orders are submitted on that day, after Ian submits his order, what would be Ian's average trade price? So he wants to sell at 1983. So here are all the people willing to buy. If he's going to sell, he's got to sell to these. So he's going to sell at 1983 or better. So would he take 2002 over 1983? Yes. So he'll clear 300 at 2002. He'll clear 400 at 1989. He'll clear 200 at 1984. And he's not willing to go to 1970. So what's going to happen over here is you're going to have 1983. And you're going to have that new price in here. And you'll have 100 shares sitting there to be sold. What's his average price? Well, he sold 300 at 2002. He sold 400 at 1989. And he sold 200 at 1984. So this is 6006. Here we have 7956. My writing is terrible here. 7956, and here we have 3968. And that'll give us a total of 17,930. He got 900 shares out of the deal. We got 19.922. 1992, we have that somewhere. B. Zhenhu Li has submitted an immediate or cancel buy order for 500 shares of a company at a limit price of $74.25. There are 2 sell limit orders standing in the stocks order book at that time. One is for 300 shares at a limit price of $74.30. The other is for 400 shares at a limit price of $74.35. How many shares would get canceled? So what are we doing? We want to buy at $74.25. So if we're looking for bid, ask, we're going to place an order to buy for $74.25. We want 500. Fill us now or forget it. That's what immediate or cancel is, fill or kill. There are 2 sells, so there are 2 asks. One is for 300 at $74.30. So we have a $74.30 at 300, and we have a $74.35 at, we don't even need to fill this in. I can see what's going on. So $74.25. The lowest price is $74.30, so no transaction is going to happen. This would sit here as a standing limit order, except it's an immediate or cancel. So how many get filled? None, 200, or 500. Oh, sorry, it says here how many get canceled. I'm sorry about that. Not how many get filled, how many get canceled. I reversed that. How many get canceled? I didn't do my thing where I normally underline the word, and I was about to take none. I was about to say none get filled because I wasn't paying attention. So there's a learning moment, a teachable moment there. How many would get canceled? Well, 500 would get canceled. There would be no fill. 500 would be canceled. It doesn't get filled. 36. A financial analyst is examining whether a country's financial market is well functioning. She finds that the transaction costs in this market are low and trading volumes are high. She concludes that the market is quite liquid. In such a market, A, traders will find it hard to make use of their information. B, traders will find it easy to trade, and their trading will make the market less informationally efficient. That doesn't sound right. It'll make it more informationally efficient. I can get rid of that. Traders will find it easy to trade, and their trading will make the market more informationally efficient. Yes. Let's look at this first one. Traders will find it hard to make use of their information. Now, there may be some of you out there saying, but isn't that true? Isn't in an efficient market that you can't profit on any information that's already in prices? Well, yes, in an efficient market. But this is not saying that traders will find it hard to profit on information. It's saying traders will find it hard to make use of their information. Well, no, they'll find it hard to profit on their information. But so A is not really saying what we think it's saying. C, traders will find it easy to trade. Their trading will make the market more informationally efficient. 37. The government of a country whose financial markets are in an early stage of development has hired you as a consultant on financial market regulation. Your first task is to prepare a list of the objectives of market regulation. Which of the following is least likely to be included in this list of objectives? Minimize agency problems in the financial markets. Ensure that financial markets are fair and orderly. ensure that investors in the stock market achieve a rate of return that is at least equal to the risk-free rate of return. It should jump out at you which is least likely. C is the least likely. There is nothing when you're looking at when you're regulating a market. You do not regulate return at all. The return is what the market is going to be. You do not regulate that. So C is your answer. In leaving this section, let me just make a note. I make fun of Donald Trump. I do, because it's just easy to make fun of. He's a character, so it is easy to make fun of him. I don't know if he's going to be a good president or a bad president. I have no idea. There's some things that I kind of agree with him. Other things I completely disagree. I'm from Canada, so looking in, it's kind of comical. However, we shouldn't laugh. We have a prime minister here who's completely on the opposite end of the spectrum. I mean, every flowery idea he gets about a kumbaya moment, he wants to design a great big group hug for Canada and send the taxpayers the bill for it. So we are paying for a lot of his flowery thoughts and emotions. So, you could easily laugh at us just as much, I think. We're way at the other end, and it's just as uncomfortable for the taxpayer.